Welcome to our YouTube Live, and this is to cover what happened at the FOMC meeting just now. Now, obviously, lots of people paid attention to this meeting, not so much for the monetary policy, although that's obviously very important, but also to think about what's going on with the banking crisis in America and now elsewhere. Now, the actual policy decision was pretty much as expected. People thought it would be a 25 basis point hike, and that's what we got. So 25 basis points is 0.25%. And so now, we're a little bit tighter than we were before this meeting. Now, one of the points that emerged over the course of the meeting repeatedly was that what happened in the banking sector right now is that it's likely to lead to tightening of monetary policy indirectly. And that's because if banks are tightening lending standards, then that tightens credit conditions. So this is doing the work of the Fed for it. So if you're really into conspiracy theories, you'd say, well, the Fed planned this, right? So they want this to happen because that's going to tighten financial conditions and they won't have to hike so much as a result. Now, one thing that was also stressed was that the duration of this crisis and its severity are unknown. However, if there is tightening of policy, the effects of that on inflation is pretty well understood, and on demand and on the economy. So at the moment, the real problem is we don't know how long this crisis is going to last. Powell started off with a kind of special section which he read out, which was about the crisis and how deposits are very safe. So that was reassuring, I guess, if you are a depositor in the US. But obviously the BTFP program is, some people call it the BTFD program. That's what my co-host of the podcast called it, Michael Pugh, because this essentially allows banks to take their treasuries, their mortgage-backed securities, which are trading at 70 cents on the dollar, hand them to the Fed, which will pretend that it's worth par, in other words, $100. And then they can borrow against that using this BTFP program. So if they do have safe and liquid assets, they don't have to have a fire sale like Silicon Valley Bank had to. They didn't have to sell them and crystallize a loss. They don't have to sell their treasuries. They just hand them to the Fed, which they can do in almost unlimited size, get a year-long loan, collateralized loan from the point of view of the Fed, so it's very safe, and that solves their liquidity problem. So as people go out of the door of their bank, if they want to take their money out, and if they have treasuries, they can afford to give them that money. Because the real problem was that if you have lots of depositors leaving, you have to sell assets, and if those are treasuries, you're crystallizing a loss at the moment because rates have gone up due to the Fed's policy, and there's a loss on those bonds. Now, if you hold them to maturity, of course, there's not a problem. And that was the whole point, right? But Silicon Valley Bank was kind of special. And that's another thing that Powell stressed, which is that it had a very focused deposit base, as we all know, in the tech sector. And also the rate of the run on the bank was unprecedented. Once it started circulating on Telegram that the bank was in trouble, the deposits just flew out of the bank. And one of the points Powell made was that in the review that they're doing, which Vice Chair Barr is supervising, of what went wrong, they're going to look at how policy needs to adapt to this new era of social media and very rapid deposit flight. Because once people are scared and they can spread the message instantaneously, or I've just taken my money out of Bank X, all of the people that follow them can see the same thing. And Silicon Valley Bank was kind of special because this herd behavior was exacerbated by the fact that the depositor base was in one sector, which is also very tech savvy. Plus, a couple of the VCs were actually telling their startups, take your money out. Like Peter Thiel apparently was doing that. So, yeah, I think this is going to be really interesting to see what policy changes and supervisory changes they come up with to stop Silicon Valley Bank happening again. But anyway, let's go through some of the stuff that we actually saw. So I hastily put together some slides just to show you what's going on. Let me share this. Okay. And there will be questions at the end. And if you are a supporter of PensionCraft on YouTube, we'll push you to the front of the queue. And of course, if you do a super chat, we'll push you to the front of the queue for the questions at the end. And I should also mention, actually, let me mention that first, right? Which is many happy returns. We did a special episode on contagion. So if you want to see what we said, then the cocoa powder keg was the brilliant name that Michael came up with. So contagion, chain reactions, and the cocoa powder keg. So if you want to hear about contingent convertible bonds, a fascinating topic, but also generally about contagion and what can go wrong, then yeah, check out our podcast. And maybe in future we'll get Michael to come on one of these. That'd be great. He just did a live stream with us a week ago, and he was awesome. Let me just say, brilliant. So let's have a look at the data that we've just seen. Right. So this is kind of interesting. This is the last time I did one of these was the previous meeting, and that was in February, of course. And this is how the market saw the probabilities of rate hikes at that point. They thought they were almost at the end of the cycle. There were 2 more rate hikes priced in, and they'd peak in March and then keep rates there until, the 475 to 500 basis point range until September. And then the first rate cut would be November 2023. So that would be the meeting in which they cut rates. Fast forward to today, and it's a completely different story. So instead of peaking at 475 to 500, now we're going to peak at 500 to 525. That's a little bit higher than we were. But the really shocking thing is that the first rate cut's going to come in July, and then we're going to get cut. And so the cuts really start at that point. And by the end of 2023, we're going to be at 425. So, about 75 basis points below where we are now because of the crisis. Now, what Powell said to that when Mike McKee pointed this out to journalists, he said, well, actually, that's not our central case. Our central case is we're going to keep hiking until we reach a little bit higher than today, and then we're going to keep it there until probably the end of the year. So let's have a look at that. Also the change in language, because this is an interesting document. This is from Nick Timrouse, who's from the Wall Street Journal, and he shows the change in language in the Fed statement. So you can see what's been deleted, what's been added. And what Powell highlighted actually was this phrase here. So he said, focus on the words may and some rather than ongoing. So the committee anticipates that some additional policy firming will be appropriate to maintain a stance of monetary policy that's sufficiently restrictive to return inflation to 2%. So instead of saying ongoing increases in the target range. So certainly more dovish from that point of view. And why is that? Well, because some of the tightening's being done for it by this banking crisis. Because the banks are going to be more cautious about lending. That makes credit harder to get. That reduces demand, and that brings supply and demand in the labour market back into balance, and it does the Fed's job. So there's your conspiracy theory. And a summary of economic projections was also interesting, the dot plot. So this is the bit to look at. This is the median forecast. You also get a kind of central tendency and a range to show the dispersion of views. So each committee member makes a forecast for each of these macroeconomic variables for the end of this year, next year, and the year after, and then for the longer run. And they also show the previous projection from December. And what's interesting is that GDP's been revised down a little bit for this year, so weaker growth, presumably because of the crisis. Unemployment has been revised down, so 4.6 to 4.5, because the labour market's very strong. That's another point Powell was making. And PC inflation has been revised up for the end of this year. but they still think they're going to get it down to 2 by 2025. And if we look at federal funds rate, this is the key thing. Previously, they said it would be 5.1 by the end of this year, and now they say the same thing. Now, in between, there was language, there were hints from Powell when he gave testimony to Congress that they'd have to raise rates more, right? So that was seen as really hawkish, and markets were spooked by that. The S&P sold off. But now, because of this crisis and because the tightening from the banks is doing their job for them, that's changed. They're just saying that it's going to be what it was in December. So no increase in the terminal rate. And they still think that by the end of 2024, they'll have lowered rates slightly to 4.3 and then 3.1 by the end of 2025. So no easing really before the end of this year at all. It's going to stay at 5.1. That's their central case because inflation will still be high, well above their target at 3.3% by the end of this year. So let's look at the labour market. This is a plot of the number of unfilled job vacancies per unemployed person. Now that was hovering at about 2 jobs per unemployed person until recently. It's still at 1.8. So lots of jobs per unemployed person, and that's called a very tight labour market. So it's no surprise that CPI inflation is 6% because that component, the labour component, the tight labour market is likely to push inflation higher for services, the core services measure, which Powell always alludes to, excluding housing. And that stubborn part of the inflation numbers isn't really responding to monetary policy. Maybe this crisis will have an effect on that, but personally I doubt it. If we do look at non-farm payrolls, you can see that the numbers have been pretty strong. We had an incredible number, the last print but one, 504,000 new jobs added to the economy. To just keep the economy ticking over and absorb new entrants to the job market and account for retirees, you'd expect that to be around 100,000 new jobs added monthly to the US economy. But we're still running very hot, 300,000, 500,000, 239,000. So pretty strong labour market still, very strong. And if we zoom in on that as a bar plot, you can see those very strong numbers. The last but one payrolls number was incredibly high, 504,000 new jobs. So the demand for workers is still very brisk. That's a very tight labour market, and that's inflationary. That is not good news from the Fed's point of view. Now let's look at the balance sheet. Now, of course, everybody's been pointing out that, okay, you've got quantitative tightening. You're letting your balance sheet run off in a predictable way. You don't reinvest your coupon and your principal from your bonds as they mature, and that gradually reduces the size of your balance sheet from 9 trillion, and it reduced it very rapidly down to 8.25 trillion. But what happened here? It fell 7%, but then it rose 3.6% and undid a lot of the quantitative tightening. Why is that? Well, this is the BTFP, right? The Fed has essentially allowed banks to wash their sins away in its own balance sheet, and that way they can hand over their bonds to the Fed and essentially borrow huge amounts of money and ensure they have enough liquidity. And banks have been using that a lot. So somebody said, one of the journalist questions was, is this tightening? And Powell said, no, it's for a different goal. This is an emergency measure. It might have an effect, which is tightening as the balance sheet, loosening as the balance sheet expands again, but that's not the goal. The goal is simply to ensure liquidity for banks, of course. But is it tightening? Is it loosening? Yeah, I think it is. If the balance sheet gets bigger, essentially they are loosening financial conditions because they have to. The question is whether that loosens more than the tightening you've got because banks are lending less. Because banks are going to be really careful at this point. You don't want to kill the bank by lending to people who won't pay you back. So credit conditions are going to get tighter. So this loosening probably will be less than the tightening that banks are going to do as a result of the crisis, or at least that's what the Fed expects. Now, last time there were lots of talks, there was a lot of mention of inflation, disinflation, which is when the rate of inflation falls. It's still positive, Prices are still increasing very rapidly. They're just not increasing as rapidly as they did previously. Now, it was mentioned about 10 times in the previous press conference. That was in February. It wasn't mentioned. Well, it was mentioned as a joke this time because what everyone was talking about was the fact that inflation's looking pretty sticky. So core inflation is at 5.5, CPI inflation 6 for the headline number. It has come off a lot from the peak, but notice that it seems to have slowed down and seems to have stuck. Core seems to have stuck at its current level for the previous print, and a lot of people were worried by that. Now, a lot of these components will start to go into reverse. So energy, for example, if you look at it on a monthly change, that's the right-hand panel here versus the left-hand panel, which is annual. This shows you the kind of recent changes. Airline fares going up again, that's quite volatile. But if you look at fuel oil, that's actually gone into deflation over the last month. And so has utility piped gas and used cars and trucks. Remember, those were the things that drove it up in the first place when we first got the spike. And on an annual basis as well, we've got disinflation for used cars and trucks. A lot of the services components are still going up though, and that's what worries Powell. He's not so worried about shelter. He thinks that that's due to rents, which will start coming down later in the year. They can see that in the pipeline if they look at the latest rent agreements. But the sticky component is the core services, excluding housing, because that's driven by wage growth and the labour market's very tight. If we look at core PCE inflation, that's the one the Fed actually looks at, the personal consumption expenditures inflation. Again, it doesn't seem to have stopped. It doesn't seem to have gone down much at all. You know, peaked at the beginning of 2022. It's down a little bit since then. It peaked at, I don't know, maybe 5%, a little bit more than 5%. Currently it's at 4.7. And the latest print ticked upwards slightly, which is not good. So that's clearly a concern. If we look at inflation expectations, so this is what markets expect for inflation over a 5-year period, starting in 5 years, that's actually pretty well anchored. It's pretty close to 2%, which is what the Fed's target is. So people do believe that the Fed is credible and it can get inflation back to 2%. So, you know, that was a positive, and the Fed would see that as a positive as well. So let's go back to those tighter conditions, because that's really critical. This is a National Financial Conditions Index. And at the previous meeting, a lot of people were confused because Powell was saying conditions are tightening. But if we looked at this measure, it actually showed the number was going down. So down means easier credit conditions. When it goes red and up, that means tighter conditions. So this is the pandemic period here, the peak pandemic period, when we had massive tightening. But then the Fed stepped in, we got massive loosening. And we have seen gradual tightening. But then what happened was that for about 3 or 4 months, the last quarter of 2022, in fact, conditions were easing. Markets were rallying. Credit spreads were tightening in the corporate bond market. But what's interesting is that recently, and this has nothing to do with the banking crisis, there has been a bit of tightening. So the Fed will be watching indicators like this and the numbers that go into it to see whether this tightening is actually happening and whether it can back off a little bit on its rate policy. So there was a question about that from one of the journalists too. Right, so I think that kind of ends the summary. Just see if there's anything else I should mention. Let me switch back to me, and then we'll throw it to you for some questions. So please do ask a super chat if you could, and obviously that that pays us, and we'd appreciate it. I've just had to have the roof repaired; it was leaking, so yeah, very expensive owning a house. So yeah. Please do a super chat. It helps us a lot, and we'll push your question to the front of the queue, or support us on YouTube. You know, it's very cheap to do, but it helps us a lot, and you get pushed to the front of the queue. Is there anything else I should say? Anything interesting about QT? Yeah, depositors, money is safe. He asked about Credit Suisse, and he said, well, it's not really our jurisdiction, but it seems that the Credit Suisse takeover by UBS was accepted by markets, and that was a positive. Of course, if there'd have been a messy failure and massive capital flight from Credit Suisse, that would have been catastrophic. It would have been very messy. So perhaps that was a positive. Not if you work for Credit Suisse, of course. Not good at all. There are going to be lots of job losses in Switzerland and elsewhere, London too. They have a lot of employees across the world. Soft landing, yeah, he still thinks there's a path to it. That's quite optimistic, I think. And I think that's probably enough. Yeah. Right, so let's have a look at your questions. And what have we got? So we've got a super chat from Nick Fisher. Thank you, Nick. That's really kind of you. Nick says, it would be good to get your view on where the US rates may stabilize 2 to 5 years plus. I think what we're seeing now is kind of interesting, because what we've got, let me just bring up Coifin, and I'll just pull up the rates monitor on Coifin just to show you where we are and where we were, because that I think gives you the kind of best context. Market dashboards and global yields. Let's see if that's got what we want. We've got Japanese rates there. We don't want that. Okay, let me just change it from Japanese rates to US. So Japan off, off, off. United States, on. So let's do the 1 year rate, the 10-year rate, and the 30-year rate. So this is what's been happening in the US rates market. So this was the pandemic. Everybody cuts rates. All the central banks cut rates. It stayed there for a while. And then we got the aggressive rate hikes. And if we look at the 30-year rate right now, we're talking about 4.5%. Now, if you think back to the period like 2006, you can't see it on this graph. That's where the long end of the curve typically was. So 4.5–5% for the long end is absolutely normal. So really, I know it's been a shock that rates have gone up so quickly and there have been big losses in the bond market, but 4.5%, 5% for the long end is absolutely normal. And if anything, it's low because inflation's so high. So, I wouldn't be surprised if the 30-year rate stays at around 4.5 or 5. I think what's going to keep it fairly low is growth. I think growth is going to disappoint, because remember, the long end of the curve is driven by growth expectations, but also inflation expectations. So, I think 4.5 is quite reasonable. 4.5 to 5 is where I'd expect it to end up after all of this rate hike cycle is complete and we go back to something approaching normal. For the short end of the curve, again, we've got used to zero interest rates for a decade. But if you go back further, then, 3% for Fed funds is not unreasonable. 2%, 3%, somewhere around there. But zero interest rates are a thing of the past. So I think that is something people should just factor in to their house purchasing decisions, to their money borrowing decisions for their credit cards. I think those days are over. So zero interest rate policy is gone, I think, unless there is another catastrophe in the global markets, which is unlikely. Let's hope. So I think we're pretty much where we're going to get to. If you look at the long run rate for the end of the curve, so if we go back to the dot plot and have a look at where the Fed thinks we're going to end up, their longer run short-term rate, the expectations of the committee at least, would be something like 2.5%. So, that's where we're going to end up according to the Fed. And if we look at the range of expectations for the dots, it's somewhere between 2.3 and 3.6. So, if anything, it's skewed to the upside in terms of where policy is now, neutral policy as they call it. So, yeah, short end of the curve about 3%, long end of the curve about 4.5 to 5 is the kind of neutral yield curve where I'd expect it to end up. Now, if there's a huge growth surge, or if there's a huge growth surge, what I'd expect is the long end of the curve would go even further. But I think that's unlikely given where we are today. But that would be what would drive it up further, and I think it's unlikely. If you just look at these growth expectations from the Fed, we're talking about 0.5% for this year, just growth, almost a recession. The new forecast is 0.4, even closer to recession for 2023, and very weak growth for 24 and 25, 1.2, 1.9. So 2025, you go back to the long run average of 1.8. So, not great growth, and that'll keep the long end fairly subdued in terms of yield. So that's where I'd expect us to go, and that's the kind of logic I'd use to gauge where we're going to end up. So obviously I haven't got a clue where we're going to end up, but that's how I'd approach it. And I should say, as part of my market crash shopping list, I bought US long dated treasuries. They're still underwater a little bit, but I still think that growth will disappoint, and that's going to drive down yields, as will falling inflation, and that'll push up the price of those long duration bonds. So that's why I think long duration bonds are still cheap. That's my opinion, not advice. Okay. And short end of the curve, I'm reaping that 4% income by buying essentially a money market fund, CSH2, which is an ETF, in my fund portfolio, but also part of my core. Okay, so that's my view. And Leonard von Nebelschutz, who always attends these, thank you, Leonard, who says he supports us on YouTube. Thank you for that, Leonard. Let me stop sharing. I'm doing this. Very good. Leonard says, Ramin, many of the tightenings in credit markets seem to pop up in mid-March. Just a coincidence? Okay. I think it probably is a coincidence. Let's have a look. Let's have a look at the financial conditions right now. And of course, I'll share this with you in just a moment after I pull up the spreads, courtesy of Fred, the St. Louis Fed's financial database, which I love. And credit spreads, here we go. Let's pull this over here. Let's share. Okay. There we go. Right, so this tells you the credit spread is a measure of how much additional compensation you receive for taking a certain company's credit risk. Now, if you're worried about the companies and about the macroeconomic situation, that spread will widen. So it happened in 2020 in March. Okay. So yeah, that was the pandemic. Okay, so it would take a weird kind of logic to say that was a typical credit driver. And then if we go back to this widening, this was the global financial crisis. That was in November. But was there one in March? Yes, there was. Okay. So maybe you're right. Maybe I'm disproving my own point. Here's another spike in March. Maybe. No, October. Yeah. Yeah, I'm not convinced this is really known, Leonard. That was October as well. So, yeah, obviously the one for the pandemic was to do with the pandemic. Yeah, so I don't think March has much to do with it, but we haven't had much of a widening so far. If we look at the latest year's data, you can see that the credit spreads have widened a little bit. So single B, which is the lowest credit quality on this graph, has widened to about, 5.1. And if we go back to where we were during the pandemic sell-off, it widened to about Oh, can I get my mouse over that? Yes. It widened to 11.9. So, I'd expect that to go above 700 basis points if we're going to get a recession, and it hasn't. So, still a lot of complacency in that credit market, I think. And if we look at an ETF, which gives you exposure to credit, so something like HYG, which is a junk bond ETF. HYG, but not the UK one. This is the ETF, which is the biggest junk bond ETF in the US. And it has sold off a little bit as those spreads widened, and of course as rates increased, risk-free rates, but no huge sell-off as a result of the credit spread widening. This sell-off is due to risk-free rates increasing and not due to credit spreads widening, which I think could give it another leg down. So as I say, this is one of the things I'm looking at for my market crash shopping list. If these spreads widen to about 700 basis points, I'll be very, very interested in buying US high yield credit. But from where we are today, I think it's just not attractive. The risk and reward is just not sufficient, I don't think. Brilliant. Oh, we've got another super chat. Say thank you, please. Super chat without a question from Vladimir Krasnoshapka. Thank you so much for that, Vladimir. That's really kind of you. Thank you. And he says hello from Ukraine. Even more meaningful. Yeah, I'm sorry about what's happening to your country, but thank you so much for supporting us. I feel as if I should be supporting you, but perhaps this kind of is. Next question, super chat from Alamadi, who is from the US, I guess. It's in dollars. Thank you, Alamadi. And he says, do you think the Fed's moderated approach and expected feather fall inflation, I like that, will be enough to buoy growth equities? I think it's interesting that at least today, the upshot of what the Fed was saying was that this tightening is going to do some of their work for them. In turn, that means that they may not need to increase their policy rate as much as expected previously. Is that good for growth stocks in the US? Not really. And the reason why I say that is because the thing that's doing the Fed's work for it is a tightening of lending by banks. And if banks are tightening lending, that's bad for growth. It's bad for growth stocks. It's bad for growth in the economy, which is the whole point of why the Fed can step back on its policy, because it doesn't need to tighten because something else is tightening for it. So is this good? Is today's news good about what's going on for growth stocks? Probably not, because all it means is that instead of being whacked over the head by the Fed, you're going to be whacked over the head by the banking crisis. And I'm not sure that's better for growth stocks. People might take it that way. Maybe people will think, oh, look, it's back to where we were before. Let's buy growth stocks in the United States. I think that's a mistake. I think piling into growth stocks every time we see that inflation's moderating is a mistake, because that's a hugely overvalued market still. And if you look at growth and the forecast from Vanguard for the next decade, the forecast for growth as a style in the US is ridiculously low compared to emerging markets, say, or compared to value stocks even. So I think that's a mistake, and I think piling into growth every time there's a kind of moderation in inflation is a mistake. I'd try and avoid that if I was you. Well, I'm not you, and it's not advice, but yeah, I'd say I think it's a mistake. But will it buoy growth equities? If it does, I think it'll be a temporary reprieve. And I think growth still has an overvalued. I think growth is still overvalued, and I think that's got to correct. And the way it's going to correct is through a fall in stock prices. So let's have a look at that Vanguard forecast. 10-year forecast US. And just have a look at what they're forecasting. So is this the 2023? Yeah, that's not the one I want. I want the 10-year. So let's get it from LogSeek, which is my new toy. And we're going to look for Vanguard 10-year outlook US. There we go. And I'll share this with you. And am I sharing my screen? No, I'm not. So I will. And let's zoom down till we see US growth. The 10-year forecast is 4.1%. Compare that with US equity as a whole, that's 5.7%. And if we look at EM, or stocks outside the US, global stocks outside the US, it's 8.4. So of all of these growth forecasts over the next decade, US growth has the weakest outlook. Why is that? Well, because it's overvalued. And another way to look at that is if we look at Yardeni S&P 500 growth forward PE. And if we look at the difference between growth and value, let's see if I can find it. Here we go. So this is small cap growth and small cap value via the Russell 2000. The blue line is how much the forward PE is for growth stocks, small cap growth, and that's currently at 27.9. So still high, not as crazily high. I mean, it went off the graph, right? It went off the scale, but now it's at roughly 20 to 28. Value's at 17.1. But the key thing is look at the dispersion between the two. It's still pretty big between the value, which is 17.1, and growth, which is 28. If you go back to 2008, you can see the dispersion decreased to 0. There was no premium for growth at that point, and we're just way away from that. There's been no capitulation for growth stocks, and that's why the growth forecast looks lousy. So, I'd just be cautious about piling back into growth for this reason. There we go. Next question is from Nick Fisher, who says, could you compare the similarities and differences between where we are at now versus the global financial crisis? Oh, good question. How long have we got? And where you might think the future bump in the roads may be from sharply rising rates? I mean, the whole thing with Silicon Valley Bank was what we found out was where the hedges weren't. Now, in the UK, the crisis we saw in LDI, liability-driven investing, was because of where the interest rate hedges weren't. It was this liability and asset mismatching that was fundamental to that crisis in the UK, which made our yield blow up. It almost made pension funds blow up. That was the problem. With Silicon Valley Bank, again, an asset liability mismatch in duration. If your assets have got a duration of, 30 years or 20 years, and your liabilities have got a duration of 1 year, if interest rates go up, it's a problem. You've got to hedge that mismatch. And if you don't, it's a massive abrogation of your risk management. So I think you've got to look for places where that ALM, asset liability management, and the duration matching is likely to be wonky. So where might that be? Well, we saw it was some banks. So some banks have got really long duration liabilities. They've got call deposits where people can pull money out on a 1 minute's notice. And that mismatch in liquidity between long duration bonds, which have lost money, which are crystallizing losses as the deposits go out, that was a problem. We saw it in the UK, again, ALM. So I think what we've got to look for is other ALM mismatches. Where could that be? Other banks, insurance companies, another group of people who have to do asset liability matching, Pension funds also have to do asset liability matching, and if they haven't, that could be a problem. Or pockets of leverage where people have got leveraged negative rate exposure, something like that, or some kind of mismatch in their kind of trading books. Where that could be, it's probably going to be in the financial sector somewhere, but can I say specifically? No. Okay. But similarities with 2008, what happened in 2008 was much more about the quality of the assets. It was the asset side of the balance sheet that went wrong because the mortgages, the subprime mortgages, lost value, and then the equity wasn't sufficient to absorb the losses. That's why Lehman went down. This is not about that. This is much more about the value of the assets going down because of interest rates increasing, and they're high quality assets. They're treasuries, mortgage-backed securities, agency debt, which has a AAA rating. So it's not so much the credit quality which is a problem now, it's just the risk-free rates rising which is causing the problems. But they're problems nonetheless if companies haven't properly risk managed, which was the case for Silicon Valley Bank. And apparently the Fed had supervisors at SVB which repeatedly warned them about the problem they were facing, which they must have ignored because they did nothing about it. They didn't try to hedge their interest rate risk exposure, which you can do fairly easily. I mean, it's not terribly expensive to do an interest rate swap, but they didn't for whatever reason, and we obviously know the consequences. So yeah, I think this time around it's high quality assets which are the time bomb. It's treasuries, the things which the regulators have told financial institutions to buy to boost the quality of their assets. And remember, treasuries get no risk weighting, because if you look at the Common Equity Tier 1 ratio, the CET1 ratio, which all the banks use to show, oh, look how safe we are, for Credit Suisse it was incredibly high, because if you look at treasuries, they don't count as risky assets at all. It's invisible. Treasuries are invisible to that risk measure, and yet that was the time bomb on their balance sheet which made them blow up. So I think that's one of the things that's going to come out of this. How do you ensure that banks do the asset liability matching? How can you ensure that the depositors aren't too concentrated within one sector? Because that's going to accelerate the capital flight if it happens. Because they all have the same problems, the VC cash drying up, a huge burn rate. That was going to happen at some point as the deposits shrank rapidly. And then, when everyone's messing each other saying, I've taken my own money out, have you? That's just going to accelerate things. So very rapid runs on banks is now just the new reality, I think. But the regulators are going to have their hands full trying to work out how to regulate against this kind of event. But I think ALM matching, duration matching, is going to be a big part of it. Anyway, so I think that's probably what's going to happen, and that's the difference, right? It's just the nature, the kind of source of the crisis has been safe or supposedly safe assets rather than what people recognized as risky assets previously, which was mortgages and loans. So that's the big difference. But in terms of where the bumps in the roads are going to be, I don't know. But what I'd look for would be leverage and ALM mismatches. So if you're looking at balance sheets, that's what I'd look for. And that's what regulators will be looking for now. So next question is from Glyn, who's one of our supporters. Thank you, Glyn. And Glyn says, why do some of the world's funds have base currency sterling and some US dollar? So these are world funds, right? So this is global equity, I think Glyn's talking about. Is the FX risk the same as a UK investor? I'm thinking VWRL versus FTSE Developed World X UK specifically. Right, so if the name of the fund doesn't say the word GBP hedged, so you don't see the word hedged in the name of the thing, and if you look at the fact sheet, if you look at the key investor information document, the KID, if you don't see the word hedged, currency hedged, then you're taking the currency risk if it's a global fund. Where is the currency risk? It's mostly US dollars, because 60% of the market will be US. So if the sterling strengthens versus the dollar, that's going to reduce the value of your fund. If sterling weakens versus the dollar, it'll increase the value of your fund, whether it's traded in sterling or dollars. So don't be confused by the fact that some funds are traded in dollars on the London Stock Exchange, others are traded in sterling. You're still taking the currency risk, because when you sell your dollar denominated fund, the fund will convert it back into sterling and you'll take whatever hit, which is the difference between the value of sterling versus the dollar when you bought and when you sold. So only if you've got a hedged fund will it not bear that risk. So don't be confused by that. Now, sometimes I prefer to buy sterling denominated global funds because some of the brokers I use charge you a fairly hefty foreign exchange fee. Whereas if it's the fund which trades foreign assets in sterling on the London Stock Exchange, they can convert the money almost free, or at least an incredible bid offer spread. So for them, it's very cheap to do the FX conversion, and I'm quite happy for them to do that. So that's why I buy sterling denominated foreign funds usually on some platforms. I think as far as I know, all of Vanguard's funds are sterling denominated, but on other platforms which I use, I just buy the sterling ones because it avoids the FX fee, which is quite chunky. But that would be why I choose one over the other. But for both of the funds that you mentioned, you're taking the currency risk for both of them. You know, don't be kind of phased by the currency it's quoted in. So look, it's 8:33. I didn't mean this to go on as long as it has, but I just hope that was useful. And if you haven't, please do listen to our podcast about the crisis, because Michael does a great job of those, and they're definitely worth a listen. And if you want to learn about cocoa bonds, you know, they're really great and entertaining as well. People tell me that they're entertaining. So this is the podcast, Many Happy Returns, Contagion, Chain Reactions, and the Cocoa Powder Keg. There we go. The unholy trinity of financial contagion. And as I say, hopefully Michael will be joining us for some of these live streams in future. He's great. And please do subscribe to our channel. Please do arrange a power hour with me if you want a one-to-one session to discuss investment. And of course, join our community. So if you do, then you get to access all of these funky tools, the trackers, and monitor what's going on in markets. So we have quite a wide variety of them now, and people are asking me to add them all the time. So if we look at the S&P valuation right now, it's kind of interesting. We can pull that out, and you can see that the US is currently not cheap. So it's at the 10-year average forward price to earnings ratio. And you know, that's where we are as of yesterday, and you can see what the forecast 12-month ahead earnings are, and then you can see what the various multiples, where the various multiples would put us. So we're still not really at long-term fair value. That's still 14% below where we are today. So you know, I still think the US is quite expensive relative to the rest of the world. But look, if you do join our community, you get access to these trackers, and you also get to join our Slack channel and to discuss investing with any of us whenever you want. And we've got lots of members only video content because people ask me questions and I answer for the community only, like how to buy an inflation-linked bond, you know, all that kind of stuff. It's kind of almost like a family atmosphere within the community. So please do join us on the community. If you want to learn more about that, go to PensionCraft.com. And thank you for joining us. I hope it's been useful, and good luck with your portfolios. Oh, we've got one more question. Farage, thanks for all the education. Much appreciated. Want to open a fund to trade US penny stocks from London. If you guys interested, HMU, please. There we go. Anyway, hope you all have good luck with your portfolios, and we'll speak again at the next live stream. Take care, everyone.